This is Radio Now 95.3 FM. Come for the news, stay for informed conversations.
The stock market has been reacting to news on the coming capital gains tax, first shedding over 4 trillion naira and then gaining 2.6 trillion naira after the Minister of Finance said that the federal government would be cautious in implementing the tax. The CGT is set to rise to as high as 30% once the new tax regime kicks in on January the 1st, 2026. My guest, Adeboyega Adebajo, who's an economist, joins me to discuss why this particular tax is so contentious. Good morning and welcome, Mr. Adebajo. Thank you for joining me.
Good morning, Nabila. It's a pleasure to be here.
So let's talk about why it is you've got, I don't know if I would call them investors, but the stock market essentially dancing to the tune of any sort of sentiments or words about this tax. Why? What's the issue behind it?
Okay. Well, first of all, let's say this: the stockbrokers who, we can talk about the investors holding the shares and funding the market, but the brokers on the floor do the trading, and the brokers rely a lot not just on the fundamentals of the company, but on information as to how certain policies will affect the economy itself. So for that reason, despite having such an amazing year, it's raising 42.81% since the beginning of the year up to October. We had that sudden drop, and it was unprecedented. A single day drop of 4.6 trillion naira in market capitalization. That was something. But there were two reasons why this happened. And I wouldn't say the CGT first, even though it's one of the reasons. I'll say the first thing was geopolitical jitters, essentially because of the statement credited to the U.S. president about Nigeria being designated a country of particular concern. When that statement came about, there was quite a lot of speculation as to exactly what it meant and what interpretation to give to it. Without clear interpretation, there was a lot of uncertainty. Now, the second reason is the CGT, as you have alluded to. The government coming up and saying capital gains will be subject to tax. But the fundamental reason brokers are there is to earn based on capital gains. People invest in the stock market because they want share prices to rise, and then they sell and they make a profit. It's a trade, it's trading. So if all the margins I make entirely are subjected to tax, then it means that my earnings will reduce significantly, up to 30% of that. So that was the reaction, and it was a loud reaction. Now, the Minister of Finance was at the exchange, essentially because of the listing of the Ministry of Finance Incorporated real estate shares for the mutual trust.
And I guess he just mentioned this on the buy and buy.
Well, you will understand that he's quite familiar with the capital market. He's most likely a broker himself. I will not say for certain, but I know that he was pretty much involved in the market at a certain stage of his banking career, because he was an investment banker. So if he's not a primary dealer, he's a secondary dealer.
Right.
And so he understands the nuances and the sentiments in the market. And there was a need to reassure the brokers. There was an opportunity to touch on it. And whilst he could not speak for the government in the sense of saying it will be reversed totally or stopped, he did mention that there will be a cautious approach.
Right.
And I guess the message was that he was going to go back to the villa and convey the sentiments he felt on the floor of the exchange.
So, Mr. Dibajo, I want us to talk about the tax itself, right? At 30%, a lot of independent experts say it's quite high. There are a few countries that have been used as examples that implement such a tax: France, Sweden, Ethiopia, Spain. Notably, Ethiopia is perhaps the only country there that isn't, not perhaps, it is the only country that isn't Western and isn't a first world country, as we say. And so, this idea that Nigeria is about to implement the upper limit of practices across the world for capital gains tax in a country where the economic landscape is a lot tougher and is still not, optimum.
Mm.
Would you say that this is the best way to go? Are we mismatching what our future desires are with what the reality is on the ground?
Well, I'll probably take your last sentence to be more or less what it is. We need to look at the realities on ground. We need to look at the kind of environment and the mechanics surrounding our capital market. You'll really remember that with the devaluation of the naira, in the ranking of stock markets all over Africa, Nigeria actually dropped in dollar terms. And there's only one way to build it back. Provide the market with an enabling environment. Let investors, both foreign and local, be able to come in there and to fund the market and to deepen the trade. And now that's very key. Because this doesn't just speak to, and I'm talking about the capital gains tax now, it wouldn't just affect the shares that are already listed. Whenever new companies offer shares for subscription to the public, there may be a certain, pause, a delay, a thought that, okay, so if I buy these shares at this point now, it's a new listing, what's going to happen to me when the shares increase in price and I want to take profit? A sort of ritual that takes place on the market every year is when the large corporates announce their results, the brokers go into profit taking and they get dividends. Okay, so they sell or they wait as long as they're on the list and they get their dividends. That is the way they earn. And you've got to remember that brokers are not always trading for themselves. They're trading on behalf of investors like you and I, which means that at the end of the day, their own earnings drop and what the investors get dropped. So again, roundabout somewhere, the government is taking back some income. Let's also remember that the corporates that are paying dividends have already paid a 35% corporate income tax, 30%, 35% CIT, and then the dividends that are being paid are also subject to withholding tax already. So now there's a capital gains tax that was to be introduced, and therefore it means that when I sell my shares, what I make on it will also be taxed. So that's a bit of a problem. And for investment companies, if that sale is an income, it will be taxed as a corporate income. So there are many reasons, many things which the government needs to consider again. Yes, some countries have CGT as high as that, but not all countries do that. So we need to come up with what fits our system and drives our market to profitability.
Right. Mr. Adebajo, thank you so much for joining me on the conversation and sharing your thoughts. My guest is Adeboyega Adebajo, who's an economist, joining me to discuss the reactions of the stock market to news of the coming capital gains tax. Investors and, as Mr. Adebajo has said, stockbrokers are watching keenly to see what happens, as this tax is set to rise to as high as 30% once the new tax regime kicks in on the 1st of January 2026.
This is Radio Now 95.3 FM. Come for the news, stay for informed conversations.